Tax. Those who don't understand it, pay more of it. Some random guy on YouTube. When it comes to investing for UK investors, there are 4 main types of tax to be aware of. Number 1, stamp duty. Number 2, capital gains tax. Number 3, dividend tax. And then number 4, withholding tax. Stamp duty. So when you buy shares, you usually pay a tax or duty of about 0.5% on the transaction. So you'll pay tax on the price that you actually pay for the shares, even if the actual market price is much higher. So just like your PAYE salaries, tax is taken from the source before you can do anything about it. This normally happens when you buy any existing shares in the company incorporated in the UK, or shares in a foreign company that has a share register in the UK. So as you can see in my example, this is when I bought Barclays. The total cost was £42.21 and the stamp duty was 21p, which was 0.5% of that total cost at the time. And just to emphasize, this happens every single time you buy a UK-based stock or a foreign company that has a share register based in the UK. Next, number 2, onto capital gains tax. Capital gains tax is a tax on the profit when you sell or dispose of an asset that's increased in value. So basically, it's the gain that you make that's taxed, not the amount of money that you actually receive. So let me give you an example. You bought some Tesla stock for £5,000 and sold it later for £55,000. Nice. This means you've made a gain of £50,000, which is the £55,000 minus the £5,000. And let's also say you have a job that pays you £30,000. So let's start off by actually trying to work out your total taxable salary. So as you can see here, here's your salary of £30,000 and everyone gets a tax allowance of £12,500. So the first thing you'll do is take that away from your £30,000, which will leave you with £17,500. And that will be your actual taxable salary. As you can see from this infographic, anything in the UK that is above 50k is charged at a higher tax rate, and anything below 50k is charged at a basic rate tax rate. The blue will represent your actual salary and the green will represent your gains. Because these are 2 different types of incomes, they will be taxed completely differently based on the bands that they fall into. So as you can see, the total amount of income that you've got for this tax year has added up to £67,500. Just like with your salary, where you have a allowance of £12,500, for your capital gains, you've got an allowance of £12,300. So you'll take that away from your total taxable income, which is £67,500. And once you do that, you get £55,200. So let's work out how much tax we're actually due to pay. Because your taxable salary is below the basic rate, that will get taxed at 20%. So 20% of 17,500, that will equal 3,500. Working out the actual capital gains tax, there's 37,500 that's actually below the lower tax rate. So that's going to be taxed at 10%, which would then give you £3,750. Now, there's only £5,200 that's above the higher tax rate. So that £5,200 will be taxed at 20%, which will leave you at £1,040. So adding that all together, your total capital gains tax of £4,790 plus the tax on your salary, which is £3,500. Adding that all together, that will give you a total tax bill of £8,290. That was fun, wasn't it? In fact, let's do that again, but with another example. Reverse. Tesla stock for £5,000 and sold it later for £55,000. Nice. And now you've bought some Nikola stock amounting to £100,000 and you sold it later for £50,000. As you can see, in this universe, you've made no gain. Since, of course, the £50,000 worth of Tesla gain counteracted by the £50,000 worth of Nikola losses results in no gain. So just emphasizing, capital gains tax only comes into practice when you actually make a gain. So in this example, you won't be paying any capital gains because you haven't made any. Of course, if that's all sold within the same tax year. If you invest in an ISA, you don't have to worry about any of this. So I always highly recommend in putting your investments into an ISA account so then you can sleep easy. And remember, your total ISA allowance is £20,000 a year across all the different types of ISA accounts. Now, on to the third type of tax, dividend tax. So to work out the amount of dividend tax that you actually have to pay, that again depends on the tax bracket that you fall into, which is shown here. So let's go through an example. So you get £3,000 a year in dividends and earn £29,500 in wages in the 2020 to 2021 tax year. So this will give you a total income of £32,500. So because you have a personal allowance of £12,500, you take this off your total income to leave a total taxable income of £20,000, like was shown in the example before. Since this is in the basic rate tax band, you would pay 20% tax on the £17,000 of wages. Now, you don't pay tax on the first £2,000 of dividends because of the dividend allowance. £3,000 take away the £2,000, that will leave £1,000 of dividends left, which because of the tax band it falls into, you would only pay 7.5% tax on. To actually pay this tax, all you need to do is tell HMRC by contacting the helpline and asking them to help change your tax code, and the tax will be taken from your wages or your pension. You can also put in your self-assessment tax return if you already fill one in. And just to remind you, you don't need to tell HMRC if your dividends are within the dividend allowance for that tax year.
Vegeta, what's wrong with you? Tell me what his dividend income is. It's over 9,000! 9,000!
If you earn over £10,000 in dividends, you'll need to fill in a self-assessment tax return. So if you don't usually send in a tax return, you'll need to register by the 5th of October following the tax year you had that income. And finally, withholding tax, which is pretty much the US version of stamp duty. Withholding tax is a tax levied by an overseas government on dividends or income received by non-US residents. For example, the US government charges non-US residents withholding tax of 30% on any income received from US investments. So the UK government actually has a double taxation agreement, which is known as a DTA for us, in place with many of these countries to reduce the amount of tax paid by us UK residents. So for example, when you sign up to Free Trade or Trading 212, you normally have to fill in a W8 Ben form, and this is what allows you to pay your dividends at a normal tax rate or the treaty rate of 15% instead of the full 30%. So just to emphasize, so just like your PAYE, this is taxed at source. It's 15% on all dividend payments that come from any US stocks. Again, guys, if your investments are within an ISA, you do not need to worry about this. So please invest within ISA accounts. Shout out to my boys Sarson, Dami, Daniel. You guys are amazing for reaching out to me on Instagram, giving me that good feedback, requesting this type of educational content. And don't worry guys, there's so much more to come. If this was useful for you, please remember to share and like it. Remember guys, any of you, feel free to reach out to me on Instagram if you want more of this explained to you personally. I'm happy to do that. And remember, subscribing to me will pay dividends to your future. See you guys. Bye.